Hey everybody. So last week was an incredible week for interest rates. We saw interest rates come down considerably. As far as mortgage rates are concerned, depends on the product, but you can get anywhere from, low 6% range for government stuff to mid to high 6% range for pretty much everything else. Yeah, some things are still in the 7% range, just depends on the product, but it's a heck of a lot better than, 7.5 or 8%. So what happened? Well, inflation, or should I say the lack thereof. So CPI came in at 0% inflation month over month for headline. It came in less than expected for core at 0.2%. They were expecting a much higher number. Oil came down a lot, and that helped everything considerably. What else? PPI, the producer price index on the wholesale side. That came in with deflation, the opposite of inflation, negative 0.2%. So between CPI and PPI, we had unbelievably tame inflation. Now, here's the bummer about this whole thing. We also had Fed week last week. They met and made their interest rate decision on Wednesday, which was the same day CPI came out. And, they are incredibly confusing. They really are. You never know what to expect. They were completely, Jerome Powell was completely ambiguous, let's call it. Very unclear, very lacking in confidence. And sadly, they were hawkish, like really, really hawkish in the face of weakening economy, weakening labor market. Unemployment went from 3.9 to 4%, and of course will continue higher as the months go on. And it's very clear that inflation is no longer an issue. So why do I say that? So CPI came in at low to mid 3% range. The only thing keeping CPI in that level and not 2% are two data points in the entire report, and that's shelter and auto insurance. Shelter and auto insurance, removing those two things, guess what CPI on an annual year-over-year basis is? 0.21%, essentially zero. So in all other categories, and there are many, of inflation for CPI, we're at essentially 0% inflation year-over-year. Shelter is a completely rear-view mirror looking lagging data point. Real-time shelter inflation is zero or negative, so we're looking in the rearview mirror. And auto insurance is also lagging. It's catching up to all the auto insurance or the car price increases that took place a couple of years ago. Now it's finally starting to roll over and come down. So over the course of the next 3 to 6 months, we should see that roll over. But the frustrating part is the Fed's going to keep rates too high for too long, and I'm really concerned that we're going to go into an unnecessary recession. Meanwhile, lower and middle class people are suffering dearly. Paycheck to paycheck people are suffering dearly. You know who's not suffering? The top 10% and the top 5% of the country, because when they've got money in the bank and interest rates are up, they're earning a higher rate of return. But when you've got that middle to lower class family with children who are paycheck to paycheck, they are suffering dearly. It's a broken system. I hate that this is how we control inflation, by punishing the lower and middle class and rewarding the upper echelon of our society. That's just a personal opinion and personal gripe about how this whole thing works. In election season's coming quickly, I have to believe that interest rates are going to settle down from here as we get closer to the election, especially with a weakening labor, data, and also inflation obviously staying pretty darn tame. Oil staying pretty tame is helping our cause as well. 10-year Treasury at 4.25 right now is quite low compared to what it was, up to 4.75%, not just 4 to 6 weeks ago. We have retail sales coming out tomorrow. That's going to be a big market mover. If it's weak, expect interest rates to drop further. We'll keep you informed. Other than that, it's kind of a quiet week. Stay tuned. Thanks for listening.